protect your savings from a banking crisis by not keeping your savings in a bank. Welcome, my name is McCluskey. This past year, we helped 24 clients move just over $1.3 million out of banks into the much safer, stronger institution that is insurance companies. Today, we're going to cover why and how you can do it. First, insurance companies are much safer than banks. There's 3 ways we can come to this conclusion. Number 1, let's look at the history. The Great Depression, 900 banks going under. 2008, 400 banks going under. The Great Depression for insurance companies, how many went under? 0. How many insurance policies were not paid out due to the 2008 financial crisis? 0. Second, the loan-to-value ratio that insurance companies are required by the government to maintain is much more conservative than banks. Both banks and insurance companies have a portfolio of money that is paid to them by their customers, people who keep money in these institutions or pay premiums for some form of insurance. With that portfolio, they are taking that money, investing it, earning a rate of return, and that's how they're making their profits. Banks are legally allowed to be much riskier in the startup phase, taking higher loans, doing riskier investments. Insurance companies have to keep much more money liquid than banks do, usually in that 50% range, while banks can be as high as 80%. And third, if that didn't do it for you, even banks understand this. That is why banks are keeping a lot of their liquid cash in insurance companies. I saw a stat today. As of just January of 2023, Bank of America had over $24 billion in cash value life insurance, where they're able to access their money safely and tax-free. They understand where they need to keep their money. If they want it to be safe, they want it to be liquid, and they want it to earn consistent rates of return. Now, how do we actually do this? This is done by overfunding cash value life insurance. The idea here, just like banks are doing, they're doing it with what's called bank-owned life insurance, but you don't have to be a bank to own this type of life insurance. What you're doing is you are contributing a premium, but you are wanting to pay the highest amount the IRS will allow you to pay. The reason that you're doing this is you want the least amount possible to go towards the death benefit to cover the cost of insurance, and for the rest of that money to go towards the cash value. When you do this, since the money is still considered by the IRS to be considered life insurance, what's happening is that cash value is able to grow tax deferred. How is this happening? Because insurance companies, just like banks, like a high yield savings, they're able to earn a rate of return on their general account portfolio. Therefore, they're able to credit you a lower percentage. That money will continue to compound, and not only is it growing tax deferred, but you can access this money and it will transfer upon your death completely income tax free. Banks understand this. That's why they're keeping their liquid cash here. The rich, Ray Kroc, the founder of McDonald's, Walt Disney, J.C. Penney, these are people who funded their empires from cash value life insurance. People who have no interest in gambling with market volatility, tax rate volatility, people who want to fund a business, even people who want to retire, who just want their money to sit there. They want to know if the market crashes, they're not going to lose anything because of that. This is the solution. Hopefully this video is helpful. If you'd like to learn more in much greater detail, ins and outs from start to finish, click the video on the screen now, and I will see you there. Bye-bye.